Hey everyone, welcome back to Corporate Decoder. Today, BRUN Incorporated BRUN just filed their quarterly report, and I am seeing a very interesting shift happening. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is going through a major transformation after a SPAC merger, and the financials are starting to tell that story. So BRUN Incorporated is basically a technology company that provides access to powerful computer servers, specifically high performance graphics processing units, or GPUs. Think of them as the supercomputers that power artificial intelligence and really complex calculations, and they are making these available to businesses who need that kind of power. They are a relatively new company, incorporated in September 2025. They have two main filings here, one for BRUN Incorporated itself, which is the public company, and another for BRUN Holdings, LLC, which is the operating entity that they acquired. Their ticker symbols are BRUN for the common stock and BRUN for their warrants. The report we are looking at covers the first quarter of 2026, ending on the 31st of March. This filing confirms they have met all their reporting requirements for the past year and are subject to them for the last 90 days. This means they are on track with their disclosures. Now, when we look at the number of shares, it is important to note they have two classes of common stock, Class A and Class B. This is pretty common and can sometimes mean different voting rights or economic rights attached to each class. Like most public companies, BRUN includes a significant section on forward-looking statements. This is where they talk about what they expect to happen in the future, using words like believe, may, will, and anticipate. It is crucial to remember that these are just predictions and that actual results can be very different due to many risks and uncertainties. They are essentially saying, this is what we hope happens, but no promises. Now let's dive into the financial statements. This is where we get the real story. We have two sets of statements here, one for BRUN Incorporated, the parent company, and another for BRUN Holdings LLC, the operating company. This is a snapshot of the company's financial health at a specific point in time. It shows what they own, what they owe, and the owner's stake. We will focus on the BRUN Holdings LLC statements as they represent the core operations. Looking at the assets for BRUN Holdings LLC, we see total assets grew significantly from about $77 million at the end of 2025 to over $264 million by March 2026. That is a huge jump, more than tripling their assets. Their current assets, which are things they can convert to cash quickly, also grew substantially from around $19 million to over $30 million. This includes cash, accounts receivable, money owed to them, and other short-term assets. One of the biggest changes is in their operating lease right-of-use assets, which jumped from about $8.8 million to over $107 million. This indicates they have taken on much larger lease commitments, likely for data center space to house their GPU servers. This is a massive increase and shows a significant scaling up of their physical infrastructure. On the other side, we have liabilities, which is what they owe, and members' capital, which is the owner's stake. Total liabilities also increased dramatically from about $69 million to over $259 million. This is in line with the asset growth and suggests they are financing this expansion through debt or other obligations. Current liabilities, the debts due within a year, also saw a big jump from about $40 million to over $101 million. This includes things like accounts payable, money they owe to suppliers, and importantly, short-term debt. Members' capital, representing the owner's equity, changed a bit from about $8 million to $4.2 million. The accumulated deficit, which is the total losses minus any profits over time, also grew from a deficit of $17 million to over $21 million. This tells us the company is still in a growth phase and has not yet reached profitability. Now, let's look at how they made money or lost money during the first 3 months of 2026 and compare it to 2025. Revenue really took off for the first 3 months of 2026. Revenue was about $11 million, a huge increase from just $4.1 million in the same period of 2025. That is a 165% jump. This is clearly driven by their expanding operations and customer base for GPU rentals. The cost directly related to generating that revenue also went up from $703,000 to $1.58 million. This is a 125% increase. It makes sense that as revenue grows, so do the direct costs. Selling, general, and administrative expenses, or SCANDA, saw an even bigger jump from $774,000 to $2.66 million, a 243% increase. This signifies significant investment in growth, likely in sales, marketing, legal, and administrative staff to manage this expansion. They added 6 new employees just in this quarter, plus contract labor and other expenses. Depreciation and amortization, which is essentially the cost of using up their equipment over time, also climbed dramatically from $1.37 million to $4.72 million. This is a 244% increase and directly reflects the massive investment in new GPU hardware we saw in their asset growth. And then there is the colocation lease cost, the price of renting the data center space. This also skyrocketed from $810,000 to $4.67 million, a 476% increase. This confirms their expansion into new data center facilities to house all those new servers. They opened 3 new facilities in this quarter. With all this growth and investment, the company reported a net loss of about $4.12 million for the first 3 months of 2026. This is a stark contrast to the small net income of just $21,000 in the same period of 2025. This loss is expected given the rapid expansion and the significant upfront costs involved in scaling a business like this. It is important to remember that losses are common for growing tech companies investing heavily in infrastructure. This statement shows how the owner's stake in the company has changed. At the end of 2025, total members' capital was about $8.1 million. By the end of March 2026, that had dropped to around $4.2 million. This decrease is primarily due to the net loss reported for the period. The unit-based compensation of $198,000 also added a bit to the members' stake. This is where we see where the cash actually came from and where it went. For operating activities, cash flow was positive at $13.2 million in the first 3 months of 2026, a huge increase from just $1.26 million in 2025. This suggests that despite the net loss, their core business operations are generating more cash. This is a good sign that the revenue growth is translating into actual incoming cash. Investing activities, which is mainly buying equipment, used up a lot of cash. They spent almost $16 million in the first quarter of 2026, compared to just $218,000 in the prior year. This is directly tied to their massive purchase of new GPU equipment and prepayments for leases. Financing activities, which involves borrowing money or selling stock, provided $6.2 million in cash in the first quarter of 2026. This was primarily due to net proceeds from bridge loans. In contrast, financing activities used up $470,000 in 2025, likely due to lease payments. Overall, their cash position increased by $3.5 million in the first quarter of 2026, bringing their total cash and cash equivalents to over $13 million by the end of March. This shows they are managing their cash flow effectively despite the heavy investments. This section explains how BRUN Inc. came to be. It was created in September 2025, and its main purpose was to facilitate a SPAC merger. They acquired 2 merger subsidiaries, Benchmark Merger Sub I Inc. and Benchmark Merger Sub 2 LLC. These are essentially shell companies created to be part of the merger process. Its management decided to consolidate these entities because they are effectively controlled by BRUN Inc. As part of this SPAC structure, BRUN Inc. invested a small amount, $100, into these merger subsidiaries to establish them for the deal. This is a critical section for any company, especially one undergoing such rapid growth. BRUN notes that as of the 31st of March 2026, they had no operating activities other than expenses and no cash. This sounds alarming, but they then state that subsequent to the 31st of March 2026, they completed mergers that brought in about $95 million and allowed them to repay their bridge loans. Management believes they have enough liquidity for at least the next year thanks to these mergers. Here they lay out their accounting methods. They mention that accounting for fair value requires estimates and assumptions. For fair value measurements, they use a 3-tier hierarchy, with level 1 being the most reliable quoted prices in active markets, and level 3 being the least reliable unobservable inputs. BRUN Inc. is authorized to issue a massive number of common shares, up to 1 billion as of the 31st of March 2026. Only 1 share of common stock was issued to their CEO, Andrew Carrows, at the company's formation. They have no equity-based compensation plans or dividends declared yet, which is typical for a company at this stage. This note highlights transactions with related parties. BRUN Holdings LLC, a related party, incurred audit fees on behalf of BRUN Inc. In turn, BRUN Inc. recorded a payable to BRUN Holdings for these costs, amounting to $52,000 as of the 31st of March 2026. This means costs were covered by one entity for another, creating a debt between them. This is a very important section detailing significant future obligations and agreements. The company entered into a SPAC merger agreement on the 15th of September 2025. This agreement sets out a two-step merger. Basically, BRUN Holdings LLC was going to merge into a subsidiary of Willow Lane Acquisition Corp, the SEC, to become a publicly traded company. This part describes the deal terms. BRUN's equity holders were set to receive a mix of an installment note, a large amount of stock in the combined company, and potentially millions more shares based on the company's future stock price performance. This is a common structure in SPAC deals to incentivize performance. An amendment on the 13th of January 2026 confirmed the post-merger board of directors and extended the closing deadline. They also amended the earn-out agreement, adjusting the number of shares that the sponsor and another entity could earn based on stock performance. Additionally, on the 13th of January 2026, they entered into a consulting agreement with B. Luke Wild, the SPAC's chairman and CEO. He will advise on strategy and help connect the company with clients and investors. In return, he is slated to receive shares of the company's stock, subject to vesting based on stock price performance. This section explains how the company is organized for reporting purposes. They have determined they operate as one single business segment focused on providing GPU rental services. All other revenue sources support this main business. This is crucial information about what happened after the 31st of March 2026, the report's closing date. On May 8, 2026, the SPAC merger was completed. BRUN Inc. is now a publicly traded company. The BRUN Holdings LLC entity and the SPAC became wholly owned subsidiaries of BRUN Inc. This confirms the deal terms we saw earlier. The equity holders received the installment note and stock along with those potential earnout shares. This means that for accounting purposes, it is treated as if BRUN Inc. acquired the SPAC even though the SPAC was publicly traded. It is equivalent to BRUN issuing its own stock to buy the SPAC's assets. This is the big payoff for the SPAC. It is now a public company trading on NASDAQ. Now, let's look at the financials for BRUN Holdings LLC, the operating company, which provides more detail on their actual business performance. Here we see the detailed balance sheet for the operating entity. Total assets for BRUN Holdings LLC grew from $77.4 million at the end of 2025 to $264 million by March 2026. This massive increase is largely driven by new equipment and lease right-of-use assets, which we saw earlier. Liabilities also surged from $69.3 million to $259.9 million, reflecting the financing needed for this expansion. Members' capital decreased slightly from $8.1 million to $4.2 million, mainly due to the net loss during the period. The statement of operations for BRUN Holdings LLC shows the same trend of rapid revenue growth coupled with significant increases in expenses. Revenue for the first 3 months of 2026 was $10.96 million, up from $4.14 million in 2025. This is a 165% increase, primarily from GPU rentals and some blockchain rewards. Scanned expenses more than tripled, going from $774,000 to $2.66 million. As noted before, this is due to staffing up and other growth-related costs. Depreciation and amortization also jumped from $1.37 million to $4.72 million, reflecting the new equipment. Colocation costs, the rent for data centers, saw the largest percentage increase, up 476% from $810,000 to $4.67 million. This highlights the significant expansion of their physical footprint. The net loss for the period was $4.12 million compared to a small profit of $21,000 in the prior year. This is consistent with the strategy of investing heavily for future growth, even if it means short-term losses. This statement shows the changes to the owner's stake in the operating entity. The total members' capital was $8.1 million at the end of 2025. By March 2026, it had fallen to $4.2 million, again reflecting the net loss for the quarter. The cash flow statement for the operating entity echoes the trends we've seen. Operating activities generated $13.2 million in cash, a big jump from $1.26 million in the prior year. This is positive, showing the core business is healthy. Investing activities used up $15.9 million, mostly for buying equipment, a huge increase from $218,000 used in the prior year. Financing activities provided $6.2 million, largely due to incoming bridge loans. This helped cover the massive spending on equipment and infrastructure. Even with all the spending, their cash balance increased by $3.5 million in the quarter, ending at over $13 million. This shows good cash management during this aggressive growth phase. This section clarifies how BRUN Holdings LLC was formed. It was created in March 2024 and acquired its subsidiary BRUN LLC. This was accounted for as a transfer between entities under common control, meaning they just moved the existing assets and liabilities at their book value. They explain their business is providing GPU servers for AI, and that they are generally more affordable than major cloud providers. In August 2025, they formalized a multi-class equity structure with Class A, Class B, and Class C units. This is a common way to structure ownership for different types of investors or partners. Here they discuss their accounting policies. They note that estimates are important, especially for things like useful lives of equipment and the fair value of some assets. Under equipment net, we see computer hardware, fixed assets not yet in service, and other equipment. The total gross equipment value grew from $19.1 million at the end of 2025 to over $36 million by March 2026. This massive increase in equipment is clearly fueling their growth in server capacity. Depreciation expense for this equipment also jumped significantly. This section breaks down their revenue streams. Lease revenue from renting out their GPUs was $10.6 million for the first quarter of 2026, up from $3.9 million in the prior year. Blockchain awards revenue from contributing computing power to decentralized networks also increased, though it remains a smaller portion of the total. This shows their primary business model, GPU rentals, is performing very strongly. They discuss how they value certain assets and liabilities. They mention a digital asset receivable related to blockchain rewards, which was settled in the first quarter of 2026. This means they received some digital currency as payment and then it was settled. This note details their lease obligations. They have significant operating leases for colocation facilities to house their GPUs and finance leases for the GPU servers themselves. The amounts here are quite large, reflecting their substantial investment in infrastructure. For example, future operating lease liabilities are over $100 million. This is a key area. They have bridge loans from August 2025 and February 2026. The February 2026 bridge loan was for $11 million, yet they only received $9.95 million in net proceeds, indicating a debt discount. This means they essentially paid a premium to borrow that money. The interest expense, which is largely amortization of these discounts, was $718,000 for the first 3 months of 2026. Importantly, they state these bridge loans were paid off in May 2026, concurrent with the SPAC merger closing. This note details a loan from their CEO, Andrew Caros, for $1.43 million. This loan was also paid off following the merger. Here they talk about the different classes of units. They have an unlimited number authorized but have issued 8,500 Class A units and 128 Class C units. The Class C units were issued in connection with the cancellation of a warrant for a bridge loan. The valuation of these Class C units used a Black-Scholes model with specific assumptions, and it is categorized as level 3 in the fair value hierarchy, meaning it relies on unobservable inputs. They have issued profit interest units, which are a form of equity-based compensation. These units vest over time and are subject to participation thresholds for distributions. They recorded $198,000 in unit-based compensation expense in the first quarter of 2026. This section explains how they calculate earnings per unit. Due to the net loss and the structure of their units, Class A units are the only ones considered for basic and diluted earnings per unit calculations in this period, as the other unit classes are not eligible for loss distributions or are not dilutive. This is where we see the really big news. The merger with the SPAC, Willow Lane Acquisition Corp, or WLAC, was completed on May 8, 2026. This is when BRUN Inc. became a publicly traded company. Again, this means BRUN is treated as the acquirer, and the SEC's financials are incorporated into BRUN's historical results from the merger date. This is a crucial outcome. All those bridge loans and the related party loan were paid off with the funds from the merger. This significantly cleans up their balance sheet. This is the culmination of the SPAC process, with the company now listed on NASDAQ. This section gives management's perspective on the financial results. Management highlights the significant revenue growth, a 165% increase driven by higher GPU utilization and new customer contracts. They also acknowledge the shift from a small profit to a net loss, attributing it to increased operating costs and expenses related to growth. They reiterate their business model of providing GPU compute power through their own platform, third-party platforms, and brokers. They emphasize that customers take full control of the equipment once provisioned. They present key financial metrics. Revenue increased by 165%, gross profit increased by 173%, and the gross profit margin improved slightly from 83% to 85.6%. This is a good sign that they are becoming more efficient as they scale. Capital expenditure on GPUs surged by 1,211%, from $681,000 to $8.93 million. This is a massive investment in their core asset, the GPUs. Here they break down the cost categories: cost of revenue, scander, depreciation and amortization, and colocation lease costs. All of these increased significantly, as we saw in the financial statements. They point to expected growth in GPU computing and AI, but also mention uncertainties like component supply constraints, power availability, and macroeconomic slowdowns. These are risks that could impact their future performance. They reiterate their liquidity position. As of the 31st of March 2026, they had $13.24 million in cash, but a significant accumulated deficit and working capital deficit. However, they stress that the merger proceeds of approximately $95.38 million, along with debt repayment, have significantly improved their liquidity outlook. They detail the bridge loans and the related party loan, confirming again that these were paid off after the merger. This section is about life after the merger. They are now a publicly traded company on NASDAQ, trading under the BRUN ticker. The merger proceeds have bolstered their cash position and are expected to fund their expansion and working capital needs. They believe they have enough liquidity for at least the next 12 months. They state they have no off-balance sheet financing arrangements, which is generally a positive. They list future obligations, including significant lease liabilities totaling over $100 million for operating leases and $86 million for finance leases. They also mention the bridge loans and related party loan, confirming their repayment post-merger. As a smaller reporting company, they are not required to provide detailed market risk disclosures. They confirm that their disclosure controls and procedures are effective, meaning they have reasonable assurance that required information is reported on time. This part covers other miscellaneous information. They state they are not currently involved in any material legal proceedings. As a smaller reporting company, they refer to risks outlined in their earlier prospectus, indicating no material changes to those risks since then. This lists the exhibits attached to the filing, including certifications from their executives. So, what is my take on BRUN Incorporated after reading this report? The company is in a massive growth and investment phase. They are scaling up their infrastructure incredibly fast, as evidenced by the huge increases in assets, liabilities and operating costs, especially for colocation leases and equipment. The SPAC merger was a success in terms of bringing in substantial capital and paying off debt, which is a huge positive for their financial health going forward. However, the net loss for the quarter and the significant increase in scander highlight the costs associated with this rapid expansion. While the revenue growth is impressive, it is crucial to watch if they can manage these escalating costs and eventually turn a profit. The big increase in capex on GPUs and the massive jump in colocation lease costs are direct indicators of their strategy to become a major player in providing GPU compute power. The key will be how effectively they can monetize this expanded capacity and control their expenses. The risk I'm watching is whether the market fully embraces their service growth to offset the ballooning operational costs, and if they can maintain their competitive pricing advantage. What I'm actually looking for is continued revenue growth that outpaces their expense growth, leading to profitability and a healthier balance sheet in the coming quarters. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.